Commercial real estate financing can feel complicated at first. Terms like senior debt, mezzanine debt, preferred equity, and common equity can sound like a lot to absorb. But once you see how each piece fits into the capital stack, the structure starts to make sense. So, let's look at the main sources of capital, what lenders evaluate, and why the repayment plan matters just as much as the property. Begin with the total project cost. That can include the purchase price, closing costs, renovations, leasing expenses, and reserves. The money covering those items is the capital stack, and each layer has a different claim on the property's cash flow and value. At the base, you'll usually find senior debt. It's often the largest source of capital and generally has the first lien on the real estate. Because the senior lender gets repaid before the junior layers, senior debt normally carries the lowest expected return. Still, lower pricing doesn't mean less scrutiny. The lender looks closely at the property's income, expenses, tenants, leases, condition, market, and value. They'll also evaluate the sponsor's experience, liquidity, net worth, credit history, and ability to carry out the plan. Underneath it all is one question. Can this property produce dependable cash flow and make its loan payments? One common measure is the debt service coverage ratio, or DSCR. It compares net operating income with annual principal and interest payments. Above 1, reported income is greater than scheduled debt service. How much cushion is enough depends on the property, its income, the loan structure, and lender policy. Another measure is loan-to-value, or LTV. It compares the loan with the lender's accepted collateral value. Lower leverage gives the lender a larger cushion, while higher leverage leaves less room for value to decline. Debt yield compares net operating income with the loan amount, and unlike DSCR, it isn't directly changed by the interest rate or amortization. No single ratio tells the whole story, so lenders often consider all three. Above senior debt, some transactions include subordinate capital, such as mezzanine debt, preferred equity, or another structured investment. This can reduce the common equity needed to close, but it adds another priority claim on cash flow. Subordinate capital usually costs more because it sits behind the senior lender. Documents may include payment priorities, control rights, remedies, and intercreditor provisions, so sponsors and investors normally work with qualified advisors. At the top of the stack is common equity. Equity typically receives distributions after operating expenses and required debt payments have been made, and it absorbs losses before the debt layers do. In exchange for taking that additional risk, equity looks for the remaining upside when the property performs well. Here's a simple example. Imagine a $10 million project. A senior lender provides part of the capital, while the sponsor and investors contribute the balance as equity. Another transaction might add subordinate capital between the senior loan and common equity. There isn't one perfect stack for every property. The right structure isn't automatically the one with the most debt or lowest rate. It's the one the property can support through operations, downside scenarios, and the expected holding period. That's why underwriting focuses on the business plan. For a stabilized property, the lender may emphasize in-place income, tenant credit, lease rollover, expenses, and reserves. For a value-add project, the review goes further into renovation scope, timing, leasing assumptions, contingency, interest reserves, and the sponsor's track record. The exit strategy matters just as much. If repayment depends on a sale, the assumptions should account for market liquidity, future income, transaction costs, and valuation risk. If repayment depends on refinancing, the lender will consider the property's future cash flow, the remaining loan balance, the interest rate environment, and the lending standards that may exist at maturity. A strong financing request makes all of this easy to understand. It presents the asset, sponsor, sources and uses, performance, assumptions, requested terms, key risks, and repayment plan. It supports the story with rent rolls, financials, budgets, leases, market information, and due diligence. Complex transactions require judgment, but the presentation shouldn't require guesswork. When the property, the capital stack, and the repayment plan are clear, lenders can evaluate the opportunity faster, sponsors can compare structures more intelligently, and everyone can focus on the risks that actually matter. Follow Stone Oak Capital Group for more practical commercial real estate finance education. This content is for general educational purposes only. It isn't financial, legal, tax, or investment advice. Financing is subject to underwriting, due diligence, documentation, lender requirements, and final approval.